In this video, we're breaking down 3 stocks trading under $10 that could have massive upside potential over the next several years. These are not random penny stocks with no real business behind them. These are companies operating in industries that could look dramatically bigger in a few years, including urban air mobility, digital advertising, and live entertainment marketplaces. One of these companies is trying to completely reinvent how people travel through major cities. Another still reaches hundreds of millions of users globally despite years of skepticism from Wall Street. And the third sits at the center of one of the biggest rebounds in consumer spending and live events. If these businesses execute properly, today's share prices may eventually look incredibly cheap in hindsight. The first stock on the list is Archer Aviation, ticker symbol ACHR. And honestly, this may be one of the most fascinating high-risk, high-reward technology stories in the entire market right now. Because Archer Aviation is not simply building another electric vehicle company or another AI software platform. The company is attempting to create an entirely new transportation category built around electric air taxis. Now I know for some people, that probably sounds futuristic or even unrealistic at first. But when you actually dig deeper into what Archer is building, the partnerships it has secured, and how rapidly the urban mobility market is evolving, you begin to understand why investors are paying attention. The company's goal is to launch electric vertical takeoff and landing aircraft, also known as eVTOL aircraft, designed for short-distance urban transportation. In simple terms, these are aircraft capable of taking off like helicopters but operating more efficiently, more quietly, and with lower operating costs than traditional helicopters. And if this technology scales successfully, it could fundamentally change transportation in congested urban areas. Think about how much time people waste sitting in traffic every single year. In major cities, commuting delays cost individuals and businesses enormous amounts of time and productivity. Archer's vision is to create aerial mobility networks that dramatically reduce travel times across densely populated metropolitan regions. Instead of spending 90 minutes stuck in traffic, future passengers could potentially complete similar trips in 10 or 15 minutes through electric air mobility systems. That is a massive value proposition. And what makes this even more interesting is that governments and regulators are increasingly supporting advanced air mobility initiatives because urban congestion continues worsening globally. Now obviously this industry is still in its early stages. Archer is not yet operating large-scale commercial air taxi services generating billions in revenue. Investors need to understand that clearly. This remains a speculative growth investment with significant execution risk. But sometimes the biggest long-term opportunities come from companies building infrastructure for industries that do not fully exist yet. Personally, I think that is what makes Archer Aviation so compelling. The company is essentially positioning itself at the ground floor of what could eventually become an entirely new layer of urban transportation infrastructure. And if electric air mobility eventually becomes mainstream, early leaders in the space could end up controlling extremely valuable networks and technology ecosystems. Another thing that stands out immediately about Archer Aviation is the quality of partnerships and strategic relationships the company has built. That matters a lot because emerging transportation industries require enormous capital, manufacturing expertise, regulatory coordination, and operational execution. This is not the type of business a small startup can scale entirely alone. Archer has been building relationships tied to manufacturing, infrastructure deployment, and operational expansion, which significantly improves its credibility in the market. Investors often underestimate how important partnerships become when scaling hardware-intensive businesses. And unlike many speculative companies operating on pure hype, Archer is making measurable progress toward commercialization. The company's Midnight aircraft continues moving through testing and certification processes as management works toward launching commercial operations. Certification remains one of the most critical milestones because regulatory approval will ultimately determine how quickly these services can scale. Now this is where patience becomes extremely important for investors. Markets today are often obsessed with immediate quarterly performance, but transformational transportation companies usually require years of infrastructure development before their full value becomes visible. Investors willing to look further ahead sometimes gain access to opportunities before mainstream adoption occurs. I think that is one reason Archer's stock continues attracting attention despite volatility. The market understands that if electric air mobility succeeds commercially, the upside potential could be enormous compared to where the stock trades today. Financially, Archer Aviation remains in growth and development mode, which means profitability is not the current focus. Instead, investors are watching cash position, operational progress, aircraft testing milestones, and commercialization timelines very closely. The company has maintained a relatively strong liquidity position, giving it additional runway to continue developing its aircraft and operational infrastructure. And honestly, cash matters tremendously for businesses like this. Emerging aerospace and transportation companies often fail not because the technology lacks promise, but because they run out of capital before reaching scale. Having sufficient financial flexibility improves Archer's ability to continue executing through the development phase. Another thing I find interesting is how the market may still be underestimating future demand for premium urban mobility. Initially, many people assume air taxis will only serve wealthy individuals, but over time, as technology scales and operational costs decline, pricing could become more competitive than people currently expect. We have seen similar patterns happen repeatedly throughout technological history. Early automobiles were expensive luxury products before becoming mass transportation. Air travel itself was once inaccessible to most consumers before eventually becoming mainstream global infrastructure. Now, obviously, electric air mobility still faces serious challenges. Battery limitations, infrastructure build-out, regulatory hurdles, air traffic coordination, consumer adoption, and operational safety standards all remain important issues that the industry must solve. That is why I consider Archer Aviation a speculative long-term investment rather than a guaranteed success story. But I also think many investors make the mistake of dismissing disruptive industries too early simply because the initial stages appear uncertain. When you look at transportation historically, some of the largest fortunes were created by companies that fundamentally improved mobility and efficiency. Transportation is deeply connected to economic productivity, urban development, and consumer behavior. If Archer successfully establishes itself as a leader in electric urban aviation, the company could potentially participate in a market worth tens of billions of dollars over time, and one factor supporting that possibility is the broader shift toward electrification and sustainability. Cities worldwide are increasingly focused on reducing emissions, improving transportation efficiency, and modernizing infrastructure systems. Electric aviation aligns directly with those long-term policy trends. That creates a supportive macro backdrop for the industry. I also think the psychological aspect of this investment story is fascinating. Human beings have always been drawn toward technologies that make transportation faster and more convenient. There is something emotionally compelling about the idea of bypassing traffic entirely and traveling through urban air mobility networks. That excitement itself could eventually support consumer adoption once the technology becomes commercially available. Another thing investors should pay attention to is first-mover advantage. In emerging industries, companies that establish operational networks early can potentially create powerful competitive positions later. Infrastructure deployment, regulatory relationships, and customer trust often compound over time. If Archer successfully launches commercial operations before many competitors, that early positioning could become extremely valuable. Now, from a valuation perspective, the stock's price under $10 creates an interesting asymmetric setup for speculative investors. Because the market is essentially pricing in substantial uncertainty right now, if electric air mobility struggles commercially, investors could absolutely lose money here. There is no question about that. But if the industry develops successfully over the next decade and Archer emerges as a meaningful player, the upside potential from current levels could become very significant. That is the core attraction of investments like this. Limited downside relative to massive long-term upside potential if execution succeeds. And I think this is especially important for younger investors with long-time horizons. Sometimes allocating a small portion of a portfolio toward transformative emerging technologies can create meaningful upside exposure without requiring enormous capital commitments. Another thing that gives me confidence in Archer Aviation is that this is no longer just a science fiction concept. Test flights are happening, infrastructure discussions are happening, regulatory frameworks are evolving, governments and transportation authorities are actively evaluating advanced air mobility integration. That means the industry is progressing from theoretical possibility toward practical implementation. Slowly, but steadily. And honestly, many of the best long-term investment opportunities initially look unrealistic right before they become obvious. People laughed at electric vehicles years before they became mainstream. Many dismissed streaming before traditional television models started collapsing. Revolutionary technologies almost always face skepticism during early adoption stages. The key is identifying whether the underlying trend has real economic logic supporting it. In Archer's case, I believe it does. Urban congestion continues worsening globally. Population density in major cities keeps increasing. People value time more than ever. Transportation infrastructure remains strained in many regions. Faster urban mobility solutions solve a real and growing problem. That creates genuine long-term demand potential. Now, of course, investors should expect volatility here. This stock will likely move aggressively based on certification updates, operational milestones, capital raises, and broader market sentiment surrounding speculative growth companies. But volatility itself does not necessarily mean the underlying opportunity lacks merit. Sometimes volatility simply reflects uncertainty surrounding transformative industries before adoption stabilizes. And when I look at Archer Aviation today, I see a company attempting to position itself at the forefront of a transportation shift that could become much larger than most people currently imagine. That does not guarantee success, but at under $10 per share, the risk-reward profile becomes very difficult to ignore for investors willing to think long-term and tolerate uncertainty. If this resonates with you, you're exactly who this channel is for. Please, hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. The second stock on the list is Snap, ticker symbol SNAP. And this is probably the most controversial company in this entire video, because depending on who you ask, Snap is either a permanently broken social media business that lost the platform wars years ago, or it is one of the most misunderstood turnaround opportunities in the technology sector today. Personally, I think the truth sits somewhere in the middle, but what makes Snap so interesting at under $10 per share is that the market seems to have almost completely given up on the company despite the fact that it still commands one of the largest and most engaged younger user audiences in the world. And in digital advertising, attention is everything. That point alone matters far more than many investors realize. Snapchat still reaches hundreds of millions of daily active users globally, and its strongest demographic remains younger audiences that advertisers desperately want access to. Gen Z and younger millennials spend enormous amounts of time consuming short-form visual content, messaging friends, and interacting with augmented reality features on the platform. That audience has real economic value. In fact, one of the biggest mistakes investors sometimes make is assuming a company becomes irrelevant simply because its stock price collapses. But stock price performance and actual business relevance are not always the same thing. Snap is a perfect example of that disconnect. The company's stock experienced a brutal decline after digital advertising markets weakened, competition intensified, and investors began rotating away from high-growth tech names. But throughout all of that volatility, Snapchat itself continued maintaining a massive global user base. And this is where the long-term investment thesis becomes interesting. Snap is not trying to dominate every category of social media. It is focused on visual communication, creator engagement, augmented reality, and mobile advertising experiences designed specifically around younger audiences. That specialization may actually become a strength over time. One area where Snap continues standing out is augmented reality. While many technology companies talk about immersive digital experiences as a future concept, Snap has already spent years integrating augmented reality into everyday user behavior through filters, lenses, and interactive mobile experiences. And honestly, I think the market still underestimates how important that could become over the next decade. Augmented reality is likely going to play a much bigger role in advertising, commerce, entertainment, and digital interaction than many people currently expect. Snap already has deep experience building consumer behavior around those tools. That creates strategic value. The company's advertising platform also continues evolving. Snap has been improving targeting systems, measurement tools, and advertiser solutions after facing major disruptions from privacy changes that impacted digital advertising performance across the industry. This is important because advertising technology businesses often go through painful adjustment periods before stabilizing again, and lately there are signs that Snap's advertising ecosystem may be recovering. Revenue growth has started improving again, and the company continues expanding monetization capabilities while growing engagement internationally. Investors are beginning to pay closer attention because digital advertising markets themselves are rebounding alongside stronger economic conditions. Financially, Snap generated more than $5 billion in annual revenue recently, which is still substantial scale for a company trading under $10 per share. That revenue base matters because it demonstrates the platform still holds meaningful relevance for advertisers and users alike. Now obviously, profitability remains a challenge. Snap has faced ongoing pressure surrounding operating margins, infrastructure costs, and competitive spending. This is not a mature cash machine generating massive earnings consistency right now, but what investors should focus on is whether the company can gradually improve monetization efficiency while maintaining user engagement growth. Because if Snap eventually stabilizes margins and improves advertising performance, investor sentiment around the stock could change very quickly. And honestly, market sentiment around Snap today feels extremely pessimistic. That does not automatically make it a good investment, but it does create the possibility for asymmetric upside if the business performs better than expectations. One thing I personally find compelling about Snap is that younger audiences still genuinely use the platform as part of their daily communication habits. That matters more than many investors appreciate. Social media businesses become valuable when they integrate themselves deeply into user behavior. And Snapchat still occupies a meaningful role in how millions of younger users communicate visually with friends and consume mobile content. That creates long-term monetization potential if management executes properly. Another important point is that advertisers follow attention. As long as Snapchat continues maintaining strong engagement among younger demographics, advertising dollars will continue flowing toward the platform because brands need visibility where consumer attention exists. And younger consumers often shape future consumption trends before older demographics fully catch on. This is one reason many advertisers remain highly interested in Snapchat despite intense competition across digital platforms. Another factor investors should watch closely is international expansion. Snap still has meaningful room to grow its user base and monetization levels outside core markets. As smartphone adoption continues expanding globally, visual communication platforms may benefit from increasing mobile engagement worldwide. That creates additional runway. Now, of course, there are major risks here. Competition inside social media remains incredibly intense. User behavior can shift rapidly. Advertising markets are cyclical. And maintaining relevance among younger audiences requires constant innovation. That means Snap cannot afford to become stagnant. But one thing the company has consistently demonstrated is an ability to innovate creatively around visual communication and augmented reality engagement. And honestly, I think augmented reality may become one of the company's most valuable long-term assets. Many investors still view augmented reality as experimental technology, but consumer adoption is already happening gradually through mobile applications. Snap's years of experience building AR engagement tools gives the company a potentially important head start if immersive advertising and commerce expand significantly in the future. Imagine digital shopping experiences where users virtually test products through AR interfaces directly inside social platforms. That could become a very meaningful advertising and commerce category over time, and Snap already has the technology foundation supporting those experiences. Another reason I think Snap deserves attention under $10 is because the market often becomes too focused on short-term profitability during difficult periods while overlooking long-term platform value. Technology history is filled with companies that looked broken temporarily before recovering once monetization strategies improved or broader market conditions shifted. That does not mean every beaten-down tech company rebounds successfully, but it does mean investors should be careful not to confuse temporary pessimism with permanent failure. At its core, Snap still controls a globally recognized platform with massive user engagement, strong younger demographic penetration, advanced augmented reality capabilities, and meaningful advertising infrastructure. Those are valuable assets. And when stocks trade at depressed valuations, despite retaining strategically important assets, long-term investors sometimes find interesting opportunities. I also think Snap benefits from broader digital advertising trends that still remain very favorable over the long run. Advertising dollars continue shifting toward mobile platforms, short-form content, creator ecosystems, and personalized digital experiences. Businesses increasingly prioritize measurable digital engagement over traditional advertising channels. Snap participates directly in those trends. Another thing worth mentioning is how quickly sentiment can change in technology investing. When investors regain confidence in a platform's growth trajectory, stocks can re-rate aggressively upward in relatively short periods of time, especially when expectations become extremely low beforehand. And right now, expectations surrounding Snap remain fairly low. That creates potential upside leverage if the company delivers stronger than expected engagement growth, advertising improvements, or monetization progress over the next few years. Now personally, I do not view Snap as a low-risk investment. This stock will likely remain volatile because digital advertising businesses are sensitive to economic conditions, platform competition, and changing consumer behavior. But I also think the company's relevance among younger audiences gives it staying power many critics continue underestimating. Social platforms with deeply embedded communication habits can remain influential far longer than people expect. And if Snap successfully improves operational efficiency while continuing to innovate around augmented reality and creator engagement, today's valuation could eventually look far too pessimistic in hindsight. At under $10 per share, investors are essentially buying into the possibility that Snap can stabilize its business, strengthen monetization, and continue evolving its platform for the next generation of digital interaction. That is definitely not guaranteed. But the upside potential becomes compelling if management executes successfully and the digital advertising environment continues improving. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. The third and final stock on the list is StubHub, ticker symbol STUB. And this is arguably the most interesting consumer recovery story in this entire lineup because unlike the other two companies, StubHub is not trying to invent a new technology category or build futuristic infrastructure. Instead, it sits right at the center of something very familiar: live entertainment, concerts, sports, and event ticketing. But what makes this company fascinating at under $10 per share is how big the global live events economy has become, and how structurally important secondary ticket marketplaces are within that system. Because whether people realize it or not, live entertainment has quietly become one of the strongest consumer spending categories in the post-pandemic economy. People are prioritizing experiences more than ever before. Concerts, festivals, sports games, theater shows, and live events are no longer occasional luxuries for many consumers. They have become a core part of modern spending behavior, especially among younger demographics, and StubHub operates directly in the middle of that demand curve. At its core, StubHub is a marketplace that connects buyers and sellers of tickets for live events. If someone cannot attend a concert or a game, they can resell their ticket. If someone wants access to a sold-out event, they can purchase tickets through the platform. That simple structure creates a powerful network effect, because the more events listed on the platform, the more buyers are attracted, and the more buyers exist, the more sellers want to list tickets there. Over time, that dynamic strengthens liquidity and reinforces the platform's position in the ecosystem. Now here is what makes this particularly interesting from an investment perspective. The global live entertainment industry is massive. We are talking about hundreds of billions of dollars in annual spending across concerts, sports, festivals, and entertainment events worldwide. And secondary marketplaces like StubHub play a critical role in that ecosystem, because primary ticket sales alone cannot satisfy fluctuating demand. Events often sell out quickly. Pricing varies significantly based on popularity, timing, and availability. And consumer demand frequently exceeds initial supply. That imbalance creates long-term structural demand for secondary ticketing platforms. Now, StubHub itself has been through a long evolution as a business. It has changed ownership structures, navigated regulatory changes, and operated in an increasingly competitive digital marketplace environment. But what is important right now is how the company is positioning itself following renewed focus on independent growth and marketplace expansion. The company is working to strengthen its brand identity as a global live events marketplace while improving technology infrastructure, customer experience, and seller tools. And I think that matters a lot because marketplace businesses are ultimately defined by trust and usability. If users trust the platform and find it easy to transact, liquidity improves. If liquidity improves, more users participate. That creates a compounding effect over time. Another key factor supporting StubHub's long-term outlook is the resurgence of live entertainment spending. After years of disruption, concerts, sports events, and global tours have experienced strong demand recovery. Major artists are selling out stadium tours at rapid speeds. Sports leagues continue expanding global audiences, and consumers are allocating more discretionary income toward experiences. That trend directly benefits ticket marketplaces. And honestly, I think this shift toward experience-based spending is one of the most durable consumer behavior changes of the last decade. People are valuing experiences more than physical goods in many cases. Social media has amplified the cultural importance of attending live events, and post-pandemic behavior patterns reinforce the idea that experiences are worth prioritizing. StubHub sits directly in the middle of that structural shift. Now, financially, StubHub operates with a revenue model driven by transaction fees and marketplace activity. That means revenue is closely tied to total ticket volume and pricing dynamics across the platform. During strong demand cycles, the business can benefit significantly from increased transaction activity and higher average ticket prices. And in recent periods, live event pricing has remained strong, particularly for high-demand concerts and major sports events. That creates a favorable environment for marketplace revenue growth. However, investors also need to understand the cyclical nature of consumer discretionary spending. When economic conditions tighten, consumers may reduce spending on entertainment and discretionary events. That can impact transaction volume in the short term. But historically, live entertainment has shown resilience over long cycles because it remains one of the most emotionally valued categories of consumer spending. People prioritize experiences even during uncertain economic environments. Another important aspect of StubHub's business is its global scalability. Live events are not limited to one region or one market. Concerts, sports, and entertainment events occur worldwide. That gives StubHub potential exposure to international growth opportunities if the platform successfully expands its global footprint. And marketplace businesses often benefit from scale. As more users join the platform, liquidity improves. As liquidity improves, pricing efficiency increases. And as pricing efficiency increases, the platform becomes more attractive for both buyers and sellers. That network effect is one of the strongest advantages a digital marketplace can have. Now, one of the key challenges StubHub faces is competition in the broader ticketing ecosystem. The live events industry is competitive and includes multiple platforms vying for consumer attention. That means StubHub needs to continuously invest in user experience, pricing transparency, fraud protection, and platform reliability to maintain its position. Trust is critical in ticket marketplaces. Users need confidence that tickets are legitimate, pricing is fair, and transactions are secure. Any breakdown in trust can impact platform engagement quickly, so execution quality is extremely important here. Another thing I find interesting about StubHub is how emotionally driven the business actually is. Unlike purely functional technology products, ticket marketplaces are tied directly to emotional consumer experiences. People buy tickets to create memories, attend once-in-a-lifetime events, and share experiences with friends and family. That emotional connection can create strong demand patterns that are less purely rational and more experience-driven. And businesses that tap into emotional consumer behavior often benefit from sustained engagement over time. Now, from an investment standpoint, StubHub trading under $10 places it in a category where the market is still trying to determine how to value its long-term trajectory. Is it primarily a cyclical consumer platform tied to entertainment spending trends, or is it a long-term digital marketplace with structural growth potential? That is the key question, and depending on how that question gets answered over the next several years, valuation could shift significantly. If live entertainment continues expanding globally and StubHub strengthens its marketplace dominance, the company could benefit from both volume growth and pricing power within its ecosystem. On the other hand, if competition intensifies or consumer spending weakens materially, growth could face pressure. That is the balance investors need to consider. But I do think one of the most overlooked aspects of StubHub's opportunity is how deeply embedded live events are becoming in modern culture. We are living in a world where experiences are increasingly shared digitally. Social media amplifies concerts, sports events, and entertainment moments instantly across global audiences. That visibility drives further demand for attendance. In many ways, live events have become both physical and digital cultural moments at the same time, and StubHub participates directly in that intersection. Another factor worth considering is pricing dynamics. High-demand events often experience significant price fluctuations in secondary markets. That creates opportunities for marketplace platforms to generate revenue from high-value transactions during peak demand periods. And when major cultural moments occur, such as global tours or championship sports events, transaction volumes can spike dramatically. That volatility can be both a strength and a risk. But overall, I think StubHub represents a very different type of investment compared to the other two stocks in this video. Archer Aviation is a long-term futuristic transportation play, Snap is a digital attention and advertising turnaround story, and StubHub is a consumer marketplace tied to real-world experiences that already exist at massive scale. That diversification of exposure is what makes this trio interesting together, because each company is tied to a different macro theme: urban air mobility, digital communication and advertising, and live entertainment marketplaces. Now, when I look at StubHub specifically, I see a company operating in a space with strong cultural relevance, large addressable market potential, and meaningful consumer demand resilience over long cycles. But I also see a business that must execute consistently in a competitive environment while navigating consumer spending cycles. That combination creates both opportunity and risk. At under $10 per share, investors are essentially betting on continued strength in live entertainment demand, successful marketplace execution, and long-term platform relevance in a growing global experience economy. And if those conditions hold, StubHub could potentially re-rate significantly higher over time as the market gains more confidence in its long-term earnings potential. But like all investments in this video, patience and risk awareness are essential because the biggest returns rarely come from certainty. They come from identifying businesses that are still being mispriced relative to their long-term potential. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Now I want to ask you this. Which of these three businesses do you think has the strongest long-term competitive moat? Archer Aviation with futuristic transportation, Snap with global digital attention, or StubHub with real-world marketplace liquidity? Let me know in the comments. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.